And I just want to start with a little story. Let's see if I get this right. There was a third grade student decades ago who was not especially good at math nor memorization tasks, but he was really good at research and scientific experiments and experimented with everything in the classroom from magnets to building circuits. And his third grade teacher, Mrs. Ficalora, I believe, designated him as the class scientist. Now, if you haven't guessed by now, that third grade student was Andrew Lowe. And I share this story for a couple reasons. One, I learned of that by reading your book, Adaptive Markets. And if anybody on the call wants a free digital copy of the book, please contact us and we will send one out to you. And the other reason I share that story is I'm 100% confident Dr. Lowe will do today what he did for his third grade students. Was it 2 decades ago? 3 decades ago? One, maybe inspire us to do our own research and or by sharing your insights, help us make sense of this wacky world in which we live. So again, we're thrilled to welcome Andrew Lowe. He's the Charles E. and Susan T. Harris Professor of Finance and the Director of the Laboratory for Financial Engineering at the MIT Sloan School of Management. So Andrew, again, thank you so much for joining us. I will turn the floor over to you, my friend.
Wonderful. Thank you very much, Bob. Appreciate it. And thank you all for joining this webinar. Happy to be here and sharing with you some of the thoughts that I've been working on with regard to some of the bigger challenges for the financial realm. From what I understand about the Branda Center, you're focusing on big problems, long-term investments, and I think that the title of my presentation should give you a sense of the scope that I hope we'll be able to cover. Can financial engineering cure cancer, reverse climate change, and solve the energy crisis? The answer is, of course. The question is how. And excuse me, I'm going to try to tell you that in the next half hour, 45 minutes. And please do stop me with questions or comments. But I will leave time at the end for discussion as well. Also, I apologize for my somewhat raspy voice. I just got back from Tokyo for a couple of days ago and still suffering from a combination of jet lag and a raw throat from lecturing for 5 days. So I hope you'll bear with me. So I want to start with just a bit of background that Bob mentioned, which is my worldview, which is the adaptive markets hypothesis. I'm sure you've heard of the efficient markets hypothesis that Gene Fama and others have pioneered. One of the things that I discovered early in my career is that as you start to test out the ideas of modern neoclassical economics using financial data, what you find is that our mathematical theories don't fit the data very well. We may act in our self-interest, as economists would like to believe, but we make mistakes, and we learn from those mistakes, and eventually we figure out how the world works. That process is what I call the adaptive markets hypothesis, and in 2017, I published a popular version of it that describes in plain English, how these ideas fit together. For those who want a little bit more rigor, just this last month, I published a more academic monograph with all of the equations that I did not include in 2017. And the basic idea is taking a phrase from the evolutionary biology literature. Nothing makes sense in biology except in the light of evolution. I would argue that nothing makes sense in finance except in the light of adaptive markets. And so what I'm going to try to do today is to talk with you about some of the bigger ideas in finance, how to deal with things like cancer, heart disease, other kinds of biomedical challenges, and on another level, how to deal with sustainable energy. So I'm going to start with an example and an observation. Biomedicine is at an inflection point. We are able to deal with diseases today that we've never been able to address before. And I'll start with a couple of examples. These two kids, Caroline and Cole Carper, they were born with a rare condition that causes blindness from birth. It's a single gene mutation, a typo in your DNA, that prevents your eyes from producing an important biological compound. And without it, after about 6 months after you're born, you are legally blind. And they were part of a clinical trial in May of 2016, where a new therapy called gene therapy was discovered and developed, where they would take the correct version of the gene, put it into a virus, and inject the virus in the back of your eye. And the virus would swap out the defective gene for the correct version. And after a while, your eyes start functioning normally. After a few days, this is what Caroline had to say about her treatment. I went outside when it was snowing and I was like, oh, I can see the snowflakes. It was really cool to actually see something that I've never seen in my life before. That's an extraordinary example of gene therapy. The blind shall see, the lame shall walk. That's usually reserved for religious experiences, but it's happening now thanks to all of the amazing breakthroughs that are being pioneered. And in this monograph in 2016 that was published by my colleagues Phil Sharp, Susan Hockfield, and Tyler Jacks, they call this convergence. The convergence of all of the various different omics fields of the life sciences, the engineering, and the physical sciences have produced these incredible breakthroughs. Genomics, epigenomics, transcriptomics, proteomics, all of these omics have experienced tremendous advances with the exception of one, and that is economics, because you still have to pay for stuff. And the models that we're using for funding biomedical science is very much the same as we've been doing for the last 30, 40 years. And that needs to change. In particular, there's this thing called the valley of death that I kept hearing about as I learned more about biomedicine. I got interested about 15 years ago because friends and family was dealing with various kinds of cancer. And I kept hearing about the valley of death. And I was wondering, what does Southern California have to do with innovation? And then I realized that it's not a physical location. It's the period between basic fundamental science and clinical trials involving human patients. That distance requires money, and it's really hard to come by. And so the question you might ask is, why? Why do we have a valley of death? And as an economist, I have an answer. It has to do with the fact that early stage scientific discovery in many fields is really risky. And it's not just risky, it's also uncertain. I'm using the economic distinction between risk and uncertainty. Risk is the randomness that you can parameterize in a normal distribution or a log normal distribution. And uncertainty is the randomness that you cannot parameterize. That's the unknown unknowns. And the fact is that all of these breakthroughs are actually increasing the uncertainty of financial investments in these opportunities. And so I try to communicate this to my MBA students by asking them to choose among 4 different financial investments. I don't tell them what the financial investments are or over what time period they spend. I just show them what happens if you put $1 in each of these and you leave it there for an unspecified investment horizon. The green line turns $1 into $2, not very rewarding, but not particularly risky. The red line turns $1 into $5, way more rewarding, but quite a bit more risky. The blue line is the most rewarding of all, but it's also the riskiest. And the black line is somewhere in the middle. So let me just ask all of you to choose one of these 4 for your kids' college retirement fund or your parents' life savings if they're asking you to help them manage it. which one would you pick? And I normally would have time to do a poll, but in the interest of time, I'm going to skip that and just tell you what my students picked. None of them picked the green line because they feel that it's not interesting enough. One or two of them picked the red line, which surprises me because in a minute you'll see why. I get 3 or 4 that pick the blue line. Those are the future hedge fund managers and startup entrepreneurs. But the vast majority pick the black line, which I suspect is the most popular in this audience because it seems to get the best trade-off between risk and reward. And so at this point, I tell the students what they picked. So first of all, the time period goes from 1990 to 2008, multi-year investment horizon. The green line is US Treasury bills, the safest asset in the world, at least for the next few weeks. We'll see what the budget discussions bring in Congress. But assuming that we agree to pay our bills, the green line is not particularly rewarding. And if you put your money into that in 2008, you would have earned basically nothing since then, and less than nothing in real terms. The red line is the S&P 500, the US stock market. Very few people choose it, even though most of my students actually have it in their portfolios because of their 401k plan. And if you put your money in that, congratulations, you would have done very well. The blue line is the single pharmaceutical company, Pfizer, one of the largest pharma companies in the world, way more risky. But if you invested in that, congratulations, you would have done spectacularly well. And now, for the most popular investment, the black line, what is that? That is the feeder fund to the Bernie Madoff Ponzi scheme, which is why I had to stop it in 2008. That's when the Ponzi scheme blew up. Now, I give this example to my students to illustrate the human nature of investing, which is that all of us are attracted to high-yielding, low-risk assets. And in finance, we have a concept to quantify that. That's called the Sharpe ratio, after Bill Sharpe, the Nobel Prize-winning economist in Stanford. It's the ratio of the expected return of an investment above and beyond T-bills divided by the risk of the investment, which is typically measured by the standard deviation of the returns. And all of us are drawn to high Sharpe ratio investments. In this case, the Sharpe ratio of the S&P 500 and the single company Pfizer, they're about the same, 0.34. On paper, the Sharpe ratio of the Ponzi scheme was an order of magnitude larger, which is why it drew so many people into it. The reason I show this example is the fact that biotech has had a Sharpe ratio that has been declining over the last several years. And that's really what's created the valley of death. So here's a more concrete example. Imagine an investment that costs $200 million, wait 10 years, and the probability that at the end of the 10 years, I give you any positive return, that's 5%. How many of you would be interested in investing in this? When I propose this to my students, I usually get 0 takers. Occasionally, I'll get a student who will say, Professor Lowe, you didn't tell us. In the unlikely event that there is a payoff at the end of 10 years, what is it? You see, most students don't even need to know. When they look at $200 million, 10-year horizon, 5% probability of success, 95% failure rate, no thank you, not interested. Well, these are the back of the envelope numbers for what it takes to develop a single anti-cancer drug. It takes about 10 years to run the clinical trials. The probability of success historically is actually less than 5%. And the cost of running those trials is about $200 million. In the unlikely event that you succeed, you generate $2 billion a year in profits from years 11 to 20. Why 11 to 20? Well, because if you have a patent for a novel compound, that's a 20-year lifespan. If the first 10 years are taken up running clinical trials, you've got another 10 years of profits from years 11 to 20. That cash flow is equivalent to a single payday of $12.3 billion in year 10. So when I ask my students this question, how many of you would be willing to invest in something that's got a 12% compound return over the first 10 years and a risk, a standard deviation of 423.5%? They look at this and say, no, thank you, not interested. This has got a Sharpe ratio of pretty much close to zero. And so this is the problem. Turns out that investing in cancer drugs is not particularly attractive relative to all of the other things you could put your money in. And this is an issue for this so-called valley of death. Drug development has three characteristics that make it really challenging. Number one, it is very expensive, on the order of a couple of $100 million to develop a single anti-cancer drug. Two, very, very low probability of success. In some cases, an unknown probability of success, but certainly below 10%. And finally, it takes a decade before you will get a return. So this triple whammy of unattractive characteristics, this is what makes funding cancer drug development and many other biomedical ventures really, really difficult. So the question is, what do we do about it? The challenge is to increase the Sharpe ratio. Now, since I'm from MIT, every slide deck that I use has to have at least one equation. And so this is my slide deck that has the one equation. It's this. We want to increase the Sharpe ratio. How do we do it? Now, here's a very, very sophisticated mathematical answer. There are two ways to increase the Sharpe ratio. Increase the numerator, decrease the denominator. That's it. That's the really subtle message. How do we do that? Well, actually, people are already doing it. Government policy, philanthropy, better science, better engineering, better organization of business, all of those things will increase the risk and increase the reward and decrease the risk. But the two methods that are not being used as much are financial engineering. That can actually reduce the denominator, and using AI to predict clinical trial outcomes, that can actually increase the numerator. These are techniques that I've been working on for the last several years in my research and in collaborations with various different individuals. So let me just very quickly illustrate to you how financial engineering can change the denominator. Instead of investing in one of these programs, imagine if we invested in 150 of them all at once. Now, I know that's going to take 150 times 200 million or $30 billion. Where are we going to get $30 billion? That's a lot of money. And the answer is simple from an economic point of view. Assume we have $30 billion. Now, I'll come back to it, so give me a minute. But if we had the $30 billion, look at what happens. If we assume that these particular programs are statistically independent and they're identically distributed with a 12% expected return and a 423.5% standard deviation, when you have a portfolio of 150 of them, the risk goes down at the rate of the square root of the number of projects. And so now, instead of a Sharpe ratio of 0.03, I've now got a Sharpe ratio of 0.33. I've increased the Sharpe ratio by a factor of 10. And so now, when I ask my students, how many of you would be interested in this? A lot more hands shoot up. And that's where I'm going to get the 30 billion. I don't have it. I'm going to get it from all of you. If I can change the risk reward characteristics to make it more attractive, that's where the money will come from. So can we really raise the 30 billion? Well, the answer is it really depends on the portfolio risk reward characteristic. In terms of how much capital we really need, it depends on the parameters of the various different projects. And I've written a book about how to do that in the case of healthcare, in case you're interested. But the bottom line is that finance and biomedical experts have to collaborate, because the problem is not a medical problem. It is not a financial problem. It is both. And so you need the joint expertise of both fields in order to be able to succeed. And so there's a lot of value in bridging the cultural gap between biomedicine and financial engineering. But if you can do that, you can make a lot of money. Now, I'm going to give you an example of that, a real life example that has to do with rare diseases. First of all, I'm sure that all of you are familiar with certain kinds of rare diseases: hemophilia, cystic fibrosis, Lou Gehrig's disease, ALS, and so on and so forth. Each of these diseases, according to the Orphan Drug Act of 1983, are rare because they affect 200,000 patients or less in the US. That's the definition that's been promoted by Congress. They may be rare individually, but it turns out that there are over 12,000 different rare diseases. And that means that in the US, over 30 million Americans are suffering from one or another of these diseases. It's really quite astonishing. That's more than the number of people that are dealing with cancer. And it turns out that for rare diseases, because of the smaller patient population, because of the often fatal nature of these diseases, we know a lot more about what's causing these kinds of problems. And so it doesn't take $30 billion of capital to make progress. 400 to 500 million will work. You don't need 150 projects in order to get diversification. 10 or 20 projects are enough. And so it turns out that you can actually create rare disease portfolios that are very, very attractive investments. But what makes it really attractive is one financial property that I think this audience will appreciate more than most. And that is that because these rare diseases are so different from each other, because the treatments can be so different, not always, but they can be, you can actually create portfolios that are pairwise uncorrelated. And this is a really special property. To understand how special it is, those of you who have finance backgrounds, let me ask you a question. How many of you can name 5 financial investments that are pairwise uncorrelated? You can invest in whatever you want: stocks, bonds, currencies, commodities, real estate, infrastructure, private equity, anything among the financial investments that you know of. Can you name 5 of them that are pairwise uncorrelated with each other? The answer is no. You won't be able to do that. But I can give you 20 rare disease companies that have completely nothing to do with each other. And therefore, when you put them in a portfolio, they reduce the volatility at the rate of the square root of the number of projects. And that means you can actually generate a lot of value. So I wrote a paper about this in 2015 about rare diseases and portfolios. And I ran a simulation where we showed that you can get a 22% internal rate of return on a private portfolio of 20 different rare disease projects. Really quite an amazing return, given the risk level that would be generated. It would be relatively low risk. And so after we published the paper, I just assumed that people would implement it. It wasn't quite that easy. I got contacted by a former student of mine who read the paper and said, Professor Lowe, I really enjoyed reading the paper. Could you rerun your simulations, not with your assumptions, but with mine? And so I said to the student, of course, I'd be happy to do that. You know a lot more about the industry than I do. Let's do it together. So after running it, the results improved. I then proposed some other modifications, and they improved yet again. And then the former student added some more bells and whistles. Over the course of 6 months, we must have run 35 different simulations. And at that point, he came into my office and said, I just want to let you know, I quit my job yesterday. I'm going to do this. I'm going to build this company. And I got to tell you, that scared the hell out of me. I'd never had that effect on any of my students. And, you know, he had a young kid in his family. I said, Neil, you sure you want to do this? Maybe you want to let me run a few more simulations. And he said, no, I'm happy to do this. I'm very excited. So he quit his job, started the company, Initially, nobody would invest. I felt guilty enough that I put a small amount in the friends and family round. In retrospect, I wish I had done a lot more because ultimately we did find investors. We came out of stealth mode in 2017. The company is called Bridge Biopharma. And in 2018, we raised another 135. 2019, we did a crossover round, raised about 300 million, then did an IPO, then raised another 750. And as of a few days ago, this company is worth $5.4 billion in market value. Quite extraordinary. But you know what? This is not what people are proud of at Bridge Bio. What they're proud of is this, the pipeline. They now have over 20 projects that are in the works. In 2021, the very first FDA approval that Bridge Bio received for a particular enzyme replacement therapy. Later that same year, they received a second approval for a bile duct cancer treatment. This year they got a very strong result for a heart disease drug that is going to be approved later this year. The FDA has already agreed to review it for approval. So that's biotech, and being able to have multiple shots on goal using portfolio theory is certainly game changing. But there's a more ambitious goal, which is we can actually increase the odds of success by using artificial intelligence and making forecasts of clinical trial outcomes using certain different features. And so I've written papers on that. Novartis has taken some of these ideas and implemented it internally, started a company with a postdoc to do this commercially. And we're actually developing a number of investment products based upon this approach. So that's biotech. And in the last few minutes, because I do want to reserve plenty of time for Q&A, I want to show you how you can apply creative financing to a completely different field of fusion energy. You've all heard about energy transition. And I read a paper by an expert, a consultant by the name of Mark Mills, that points out that this idea of transitioning away from fossil fuels to other things, that is an aspiration, but it is not reality. We are not transitioning away from fossil fuels. If you take a look at how much we are consuming of the different types of energy, it's growing across the board. Now, it's true we're making progress in solar and wind, and we're consuming more energy from solar and wind than ever before, and the cost per watt of solar and wind is declining rapidly. So all to the good. But because population is growing, because middle classes are emerging in many emerging markets, the fact is that we are consuming more of every kind of energy, including fossil fuels, as the right-hand side of this diagram shows. And so in order for us to talk about energy transition, we need to be explicit about what are we transitioning to. If we are going to be cutting back certain forms of energy, that needs to be replaced by an alternative. And what my expert friends in the energy community tell me is that there are three choices: nuclear fission, nuclear fusion, and geothermal. And for a variety of political reasons, the main game in town right now is nuclear fusion. Now, why fusion? Well, for those of you who don't recall what fusion is, it's the opposite of fission. It's the opposite of the nuclear reactors that we have today, which generate heat and therefore electricity by splitting atoms. Fusion is the idea of squeezing atoms together, fusing them. And when you do that, you release about 4 times more energy than by just splitting them. Now, this may seem strange, but it shouldn't, because fusion energy is in fact the most plentiful form of energy in the universe. All stars are basically fusion reactors. They're basically, through the force of gravity, pulling all of these atoms together and fusing them, and in doing so, generating the kind of heat and light that we observe in our sun and all of the other stars in the universe. It turns out that because of that efficiency gain, fusion would be the ideal source of energy, especially because, well, let me just give you an example. Take a look at a typical oil tanker, right? Humongous ships. I want you to imagine taking 20 gallons of seawater, that is the seawater that's displaced by this oil tanker. So 1/600th of that seawater, that will be the amount of water that fits into this little igloo container here. Take those 20 gallons and filter that for deuterium. That's a particular kind of atom. And squeeze deuterium together with tritium, another kind of an atom, using the kind of fusion reactions that we see in the sun. When we do that, you know what that will produce? That will produce as much energy. Those 20 gallons of water will produce as much energy as all of the oil in this tanker. And by the way, it'll do that without emitting 200,000 tons of carbon dioxide, which is what you would get if you burned all the oil in this tanker. So fusion energy does not have any pollution. It's freely available and an inexhaustible fuel supply. It's seawater. That's what you're using. And you can generate it anywhere. There's no meltdown. There's no long-lived nuclear waste. And there's no terrorist fissile material that they can use. And finally, this is totally scalable, civilization-level amounts of energy. So what's the problem? Well, the problem is we don't have fusion energy reactions just yet. We're not there yet. If we were there, this would allow us to address climate change, energy security, energy equity, because basically the fuel source is free, seawater. But the reason that we are interested in fusion today is because of a few things that have happened over the last few years. Number one, in September of 2021, MIT, together with a spin-out company, the Commonwealth Fusion Systems, was able to generate a strong enough magnetic field that it could actually do the fusing of atoms that have been superheated to extraordinary levels on Earth. So that was the first breakthrough. Second, and I was there for that breakthrough because I worked collaboratively with one of the scientists that was responsible for this particular technology. Second thing that happened is that about 3 months after the experiment with these superconducting magnets that were able to generate a really strong magnetic field, the spin-out company, Commonwealth Fusion Systems, they raised $1.8 billion in a private investment round. Pretty impressive for a startup focusing on entirely new technology. Third thing that happened, it turns out that Lawrence Livermore Laboratory actually created the very first fusion reaction on this planet. The fourth thing that happened, nuclear fusion has been determined to be safe enough that it'll be regulated not by the usual laws that regulate nuclear fission reactors, but they are going to be regulated using the laws that currently regulate MRI machines, much less onerous. And last but not least, the experiment that produced more energy that was put in, that has been repeated a second time in August of 2023 and a third time in December of 2023. Really, really amazing events. So fusion, at least in the scientific part, is real. And we just need to figure out the engineering of getting this heat into the system. So this is Commonwealth Fusion Systems. This is their headquarters out in Harvard, Massachusetts. They are actually building a reactor that they hope will go live in about 3 years. So this is not a pipe dream. This is happening. And the question is, can financial engineering fund fusion? I wrote a paper about this with the head of the MIT Plasma Science and Fusion Center. And the answer is, if fusion is a commercially viable reactor that consists of a bunch of different components, you can decompose those components into subcomponents and then look at that as a portfolio and then fund the portfolio using the same tools that we fund biotech. So different application, different risk reward profile, but the techniques are very much along the same lines of creating a billion-dollar mega fund. So let me wrap up by saying that there's lots and lots of other technologies that we can use for these types of challenges. And if you're thinking about long-term investments, as the Brandeis Center is, this is the kind of domain that requires the financial innovation that will allow you to invest in the long run. So thank you very much. I'll stop here.
Andrew, thank you. Thank you so much for joining us
Pleasure.
today. And until we meet again, thanks, everybody. Take care.
Bye-bye. Thank you.
Bye.